13 minutes into the session in the equity market, we advanced 2.8% on the S&P 500, taking a chunk out of the weekly loss on the S&P. We advanced by 2.85% on the Nasdaq as well, with every single sector positive on the benchmarks in the United States. A real lift and a massive rally off the March low in this equity market that caught so many people by surprise, including many legendary investors, including Paul Tudor Jones.
If there was a franchise for humble pie, oh my Lord, there'd be a mile long to own that, because we've all had huge gulps of it, me included.
Paul Tudor Jones there on the queue for humble pie. I think a lot of people have had those gulps. You've been right or wrong at some point quite a few times in the last 3 months, that's for sure. And it will feel that way, I imagine, for the next several weeks as well. Katie Lyons, it's been really difficult to read this market. The institutional investors, for many of them who sat this rally out, it has been a huge pain trade to see this equity market rip higher off that March low.
Yeah, you're absolutely right, John. And I think that wins for best soundbite of the week. There has definitely been a lot of humble pie consumption in recent weeks. I'm going to quote our producer, Pete, for the second time this morning. He said, anyone who doesn't think it's hard to make money in this market on a daily basis has never done it. This market has been incredibly hard to time, John. When you look at the returns for retail investors' favorite stocks relative to that of hedge funds, VIP picks, that's the white and blue lines here on this chart, both have outperformed the benchmark S&P 500 in yellow, at least on a short-term basis. But it looks like retail investors were the ones who actually timed this the best, seeing the best gain of around 53% since the March low. And we've had plenty of conversations this week, John, about how it was retail bidding up the beaten down, even bankrupt names in this equity market that was driving a lot of those gains. And it was the very same names that positioning data shows us hedge fund exposure was sitting near multi-year lows. Instead, they were sticking to the stay-at-home trades like tech and healthcare. The result is smart money looking like it was just a bit too cautious here. But we also have to consider that there are macro factors involved here, John, like the abundance of liquidity coming from the Federal Reserve, the Fed totally up and opening up the floodgates with its unprecedented asset purchases, bulking up its balance sheet. Plus, you had fiscal stimulus coming online as well. Institutional investors may be underestimating the feverish optimism that would inspire. To get a better read on that optimism, John, our very own Gina Martin Adams of Bloomberg Intelligence would point you to the SIBO equity put-call ratio. It measures the relationship between bearish and bullish options. On Monday, that hit the lowest in 9 years, since all the way back in 2011, really underscores the bullish sentiment that was underpinning this rally. And what's noteworthy too on bullishness, John, if you look at the latest AAII survey data that was released just yesterday, gives us a read on bullishness for retail investors. It showed virtually no change after a 5-week rise. I'll leave that up to Peter Cheer to answer whether those unsophisticated investors are sending us the right signal yet again, John.
Katie Lyons, thank you. We'll turn to Peter Cheer now, a man who's got it right so many times over the last several months. In the middle of February, he came out with a series of bearish reports just a week, 2 weeks before we topped out on the S&P 500. Then in the middle of March, after a big drawdown, about a week or so before the bottom, he said the worst was behind us and he turned bullish. Then in early June, June 4th, shifted from bullish to neutral. Then after we got a big payrolls report shortly after, Peter Cheer turned bearish. I'm happy to say the man who's got it right so many times after so many turns over the last couple of months joins us now from Academy Securities. Peter, walk me through the following. What you've been focused on, your signpost through the downturn, through the rally that you've used just as a gauge for where things are heading.
You know, I think I've tried to do a couple things. One is really focus on positioning and sentiment and really betting against that to a large degree. Also really trying to look through the data. What is the data and what is DC going to do next? And we've spent a lot of time on the Fed. I don't think we spent enough time on exactly what DC did for us back in March and what I think they might not do for us in the coming weeks, which is why I'm so bearish right now.
So let's talk about that, Peter. Why you were initially bullish and why that has turned to a bearish stance in just the last week or so.
So I was really looking for DC not only to have effectively a CARES Act 2, but really to start pushing economic growth. So whether it was infrastructure spending or rebuilding of our manufacturing base. And I'm very worried right now that three things are going on. The economy is doing a little bit better and the stock market's doing much better, so that takes some pressure off of DC to act. We're getting closer to the election, which may cause them not to act. And now clearly we have to deal with racial inequality, inequality, and that's a really important issue that DC needs to focus on. But it, again, will probably slow down what they're able to do for the pandemic, which should be our priority right now, is getting through this next couple months. And if DC doesn't deliver, I think stocks are going to have a lot of difficulty sustaining their momentum.
So, Peter, turning points are really important. Upside surprises, downside surprises, equally as important. This is known. Policy fatigue is known. You and I are having this conversation right now. Nobody's surprised by it. Everyone knows there's real fiscal policy fatigue down in DC. What is it about that fatigue that you think is going to materialize into something that slaps everyone around the head and makes them realize this is really important?
Maybe a little bit of price action. I think you're going to start seeing more COVID headlines. You know, I think Nashville's now talking about maybe slowing down the reopening. Houston's talking about slowing down the reopening. So if you get a little bit of caution on that, that's going to really create the need for DC. And as that comes, people are going to realize, hey, this isn't happening as quickly. We also really haven't talked at all about how we're going to pay for any of this. I think that starts becoming an agenda item as we move into later June. And again, that's going to scare market participants, I believe.
So let's talk about where's vulnerable in this market. Crowded positions. You talked about looking at positioning and looking at sentiment. And arguably, where we are crowded right now is still in the safe parts of this market, the so-called safe follow the Fed strategies in IG, in places like that. That's where sentiment is really quite crowded and positioning is too, isn't it, Peter?
Yeah, so I think that's going to be something different. When we looked at this market coming down in March, you wanted to be in tech because they were the big winners from work from home. You wanted to play some of these rotations out of tech and into other assets. Right now, I think you want to be careful on the big winners, and that includes investment grade as well as the NASDAQ or QQQ and the ETFs, because I think that is where there's a much more long positioning, and that is where you're going to see the unwind. So I think you're going to see continued underperformance from those sectors in the next week or two.
So, Peter, in a series of days, weeks, whatever it could be, when risk aversion strikes in a more pronounced way, and I'm not sure if yesterday was a good example of that, you expect to see the pain in the so-called safer parts of the market.
Yes, and so I think it's going to be the safer parts of the credit market. So investment grade will actually probably underperform, which will surprise many, and it's just a function of that's where so many people are hiding their long expressions in the credit markets. And again, I think the same thing really happens in the NASDAQ, where so many people are hiding, and you've got phenomenal companies, but they're also very expensive valuations.
Peter, fantastic to get your thoughts. Constructive and optimistic when so many people weren't. And as the tide starts to turn, you're pushing back a little bit. I look forward to keeping this as a regular conversation in the weeks to come on this market. As we pick up once again in this market, the S&P 500 up by 2.5%. Want to get you the sector price action, peel this one back a little bit, get back to the market desk. Here is Abigail Doolittle.
John, not surprisingly, with that solid gain for the S&P 500 and the other majors, there is a risk-on tone sector-wise. Let's go into the Bloomberg terminal and use the IMAP function, and I'll show you what I'm talking about. First of all green on the screen. All 11 sectors for the S&P 500 are higher, 10 of them up by more than 1%. And it seems as though the cyclicals are more in favor today. Energy, materials, industrials, financials, all up by 3% or more. But right behind the financials, John, which are certainly getting a boost from yields rising as bonds fall off on the day. Tech also up about 3%. Healthcare not so far behind. So the stay-at-home stocks are doing almost as well as some of those cyclicals. So a bit of an even draw on the day between those sectors and that rotation we've seen more recently. On the week, though, decisively in the other direction. First of all 11 sectors are down on the week, John. And the best sectors underperforming, or outperforming, I should say, even though there's a decline, tech and consumer discretionary. So right there, that stay-at-home, big tech and big internet outperforming on that stay-at-home component. On bottom, as you can see, energy and the financials really taking a hit, both down at about 10%. So it's going to be very interesting to see what is ahead sector-wise. Markets and price will tell us whether or not folks really believe that there is some sort of true recovery for the economy ahead.
Abigail, thank you. A little bit of a recovery in this market relative to the pain yesterday for the equity market bulls. We advanced by 2.5% on the S&P 500, on the NASDAQ up by 2.65 percentage points. Next up on this program, we'll run you through the day ahead into the weekend and out to next week in our trading diary. From New York City, this is Bloomberg.